So let's think about a logical way to manage money. Let's say we had $100,000 and we had thousands of securities to choose from. So, one way to proceed would be to forecast the return for each security over the next year and then identify the security with the highest return and invest the entire $100,000 in this security. But then I worry that I might be wrong. My model tells me that Google would earn a return of 20% next year, which is the highest return among all the assets that I'm looking at. But what if over the next 12 months there is more bad news coming out of Google such that the return from Google is actually negative 15%? So, what I'm worried about is the fact that my forecast could be different from the realized or the actual return for Google over the next 12 months. So, this is the forecast error. So, instead of betting the bank on one security, we try to bring in both the forecast as well as the forecast error in this ratio that we call the Sharpe ratio. And the way we optimize is by focusing not just on the numerator, which is the expected return, but also on the denominator, which can be reduced quite a bit. That is, a forecast error can be reduced quite a bit by building a well diversified portfolio made up of assets that are not highly correlated. So, the key intuition is that investors care not just about return, but really about return for each unit of risk that they assume, where the risk is measured by the confidence that they have in their forecast. Suppose we have two securities, security 1 and security 2, that we put together in a portfolio with weight of security 1 being W1 and weight of security 2 being W2. Now, the behavior of this portfolio is going to depend upon what W1, W2, R1, and R2 are. As an example, consider a cocktail, say made up of rum and coke. And a cocktail is like a portfolio, with rum being security 1 and coke being security 2. So if you make a cocktail with very large amounts of rum and very little coke, then your portfolio is going to taste like rum. On the other hand, if it has a lot of coke and very little rum, then your cocktail is going to taste like coke. And but if you have 50% of rum and 50% of coke, it's going to have a different flavor. So similarly, when you build a portfolio, the behavior of the portfolio is going to depend upon how much of your assets are in security 1, how much of your assets are in security 2, and then finally you have this magic touch, which is the right combination of security 1 and security 2, which gets picked up by the covariance. And so when you have a correlation which is close to 0 or negative, then the third term here can reduce the risk of the portfolio. And that's really the magic component that comes out of an optimal combination of the cocktail ingredients. So, for example, rum and coke might be a better combination in the minds of many than scotch and coke, for example. Let's discuss the intuition behind how risk gets reduced in a portfolio. So, risk refers to the possibility that the actual outcome differs from expectations. And we form expectations based on information available at a point in time. So, for example, based on the information that we know today, we might expect the GDP growth to be 3% over the next 12 months. And we might expect a plant run by Apple to produce, say, 1 million iPads per year. Then, as the year goes by, the next few months, new information comes out. And this new information, or news as we call it, is by definition not predictable. Sometimes it's positive, sometimes it's negative, but we can't tell what it's going to be today. And this news causes our expectations to change, and therefore the actual outcome over the next 12 months differs from what we thought it was going to be as of today. Now, there are two kinds of news broadly. One component of news is very specific to a firm or an industry. So, for example, the plant that Apple runs, there might be a fire or there might be a labor strike. Now, this kind of a news can be eliminated when you have many assets in a portfolio. This is because on a day when Apple comes out with a bad news on a plant fire, ExxonMobil on your portfolio might find new oil fields outside, off the coast of Brazil, for example. On the other hand, there are other types of news which is economy wide, for example, information on GDP growth or inflation or interest rates, which affects all securities in a similar manner. Some securities are more sensitive to this news, while other securities are less sensitive to this news. And this sensitivity is what is picked up by the beta of the particular security. This figure is based on a study examining the benefits of diversification that was published in the Journal of Financial and Quantitative Analysis about 25 years ago. So, on the y axis, we have the standard deviation of the portfolio, and on the x axis, we have the number of securities in the portfolio. And as you can see, as you increase the number of securities in a portfolio, the standard deviation declines. Now, the most significant decline can be observed when you move from having just one stock in your portfolio to having 10 stocks in your portfolio. As you can see, the slope is the steepest, and therefore the benefits of diversification are the largest. And in terms of economic magnitude, you can see that the benefits are quite large. If you have just one stock in your portfolio, the annual standard deviation is about 49%. If you move from one stock to 10 stocks in your portfolio, it drops by more than half to about 24%. Moving from 10 securities to 30 securities further reduces the standard deviation, but the decline is not as significant. Now, the standard deviation is a measure of the total risk of a security, and you can break up the standard deviation into a blue part and a green part. And the blue part represents the component of security risk that can be removed, and the green part represents a component of security risk that cannot be removed. Now, each security's total risk can be broken down into a blue and a green portion. Some securities have lots of blue and a small amount of green. So these securities are what we call as low risk securities from a portfolio perspective. Other securities may have a lot of green and very little blue. And these securities would be the ones that we would worry about when we add them in a portfolio, because these securities have a lot of systematic risk. Here's a quick introduction to how hedge funds fit within the portfolio allocations of institutional investors. Reported here are the correlation between equity markets and a hedge fund composite index between 1999 and 2010. There are two observations that I would like to make. First, the correlation between the stock market and the hedge fund composite index is 0.57. It's positive, implying that on average they tend to move in the same direction. The second observation is that there are subcategories of hedge fund styles where the correlation tends to drop quite a bit. In particular, if you look at fixed income arbitrage or systematic trading or short bias strategies, the correlations are negative in some cases, implying that these strategies could help reduce the risk of an institutional portfolio. What are the benefits of having hedge funds in a portfolio? Here we have some analysis based on the sample period 1995 to 2009. The first column here represents a traditional portfolio made up of 50% stocks and 50% bonds. And here you can see that the Sharpe ratio over this period, based on historical returns, is 0.56. As you can see, the Sharpe ratio increases from 0.56 in the traditional portfolio to 0.72 in the portfolio with 20% in hedge funds, suggesting that the reward for each unit of assumed risk increases as we increase the hedge funds in the portfolio. Particularly interesting, though, is the impact of hedge funds on the numerator versus the denominator of the Sharpe ratio. So if you look at the arithmetic return row, you can see that the return increases by a small amount from 9.1 in the traditional portfolio to 9.3 in the last column with 20% hedge funds. The bigger benefit, though, is observed in the denominator, where risk declines from 10% in the traditional portfolio to about 8% in the 20% hedge fund portfolio. Thus, the benefit of incorporating hedge funds in a portfolio comes mainly from the reduction in risk.